U.S. natural gas prices have surged past the $2.50 mark this week, reaching their highest level in over a week. Traders appear to have set aside concerns about the forecasted warm weather lasting through early November, instead honing in on the potential arrival of colder air in the eastern U.S. by the second week of the month. Another significant price driver is the escalating conflict between Israel and Iran, which has the potential to push oil and gas prices sharply higher. Iran's Foreign Minister Abbas Araghchi has emphasized there are no limits in defending the country after Israel's military strikes on Iranian military targets. Although Israel has stated that it did not target energy infrastructure and Iran is reportedly avoiding direct military escalation, speculative volatility in oil and gas markets could be high next week. Additionally, with only 2 weeks remaining until the U.S. elections, Israel's ally has a vested interest in preventing a prolonged price escalation. Therefore, while a price spike is possible, it may be more speculative and likely short-lived. Meanwhile, European gas prices continue to face upward pressure driven by increasing demand in Asia and uncertainties surrounding future supplies of Russian and liquefied natural gas. With winter approaching, Europe's demand outlook largely hinges on weather conditions. Analysts generally agree that a normal or cold winter will exert additional pressure on prices. Even with average winter temperatures, Europe's gas storage levels are expected to be around 40% full by April 2025, significantly lower than the 60% recorded this past April. Overall demand in the fourth quarter will be crucial. Residential and commercial sectors are projected to see a 7% rise in demand if weather patterns return to normal, while industrial demand is expected to grow by 3% year over year. This presents a potential price risk for the end of 2024. Should colder than expected temperatures arrive, storage facilities may hesitate to make early withdrawals to balance the market unless prompt prices increase enough to offset the risk of depletion later in winter. Compounding these risks, the 5-year transit agreement between Russia and Ukraine is set to expire at year-end, and Ukraine has consistently refused to extend the agreement despite Russia's willingness to do so. As the infographic illustrates, Europe's energy situation is precarious, with gas and power demands projected to grow by 6% and 2%, respectively. Any disruption to Russian transit could significantly elevate prices. Moreover, ever since the Nord Stream disruption, Europe has been counting heavily on LNG exports from the US. But here's the irony: LNG flows to the EU expected to drop by another 6%. Sorry guys, nothing personal, just business. Asia is simply offering higher prices for the gas. Although I don't foresee a return to the extreme price levels of 2022, reaching €100 per megawatt-hour is entirely plausible. Given that the U.S. gas market is now closely tied to global dynamics, rising EU prices will likely drive up U.S. prices this winter as well, even in the event of a mild winter. A colder than normal winter could lead to even more dramatic price increases. It might seem like an ideal scenario, but natural gas is notorious for its volatility, so anything is possible. Natural gas is currently testing resistance at the $2.55 level. Should prices fail to breach this level, we could see continued downward pressure, with immediate support at $2.48 and primary support at $2.40 with additional support of a 50-day moving average. On the other hand, a decisive move above $2.55 could drive prices toward the next resistance at $2.60, with the potential to spike up to $2.70 if bullish news emerges from Iran. Please like, subscribe, and comment to support the channel. See you in the next one.